No, I think we're pretty good. Okay. All right. Well, really quickly, as all of you know, Launch Lab is what's known as a regional innovation center. We're part of 17 other organizations in Ontario, known as the Ontario Business Support Network. And our core, I'm really fortunate to work with people like Garrett, who are here with us today, and a team of advisors that are helping companies either start, grow, or scale their operations. And our advisory work can focus on financial matters like we're talking about today, raising investment. It could be sales and marketing strategies, product development, intellectual property support. Angela, who's here, knows all about that, has worked and supported a number of companies, and the work that she and her team at Queen's do is extremely valuable to us. So you know, we are here as advisors supporting companies on that starting, growing, or scaling mode. And as we're talking about today, and I'm going to just share my screen, you know, raising investment is just one of the areas that, you know, that companies get into when, oops, I'm just trying to get rid of my, there we go. So when I think about raising capital, the one thing that I want everyone, and if you've ever talked to me about this before, raising investment is, you know, but one aspect that you have to focus on with your business. And the first question is, do you need to raise investment, right? And if you do, how much, you know, what's the right timing? What's the right source of investment? So I think part of what I'd like to do today is give you a sense of, you know, at a very high level, what are the things that I think are important in terms of the fundamentals of your business? What is the role of raising investment in terms of the journey that you're on? You know, very quickly, everything we do at Launch Lab is about partnership. You know, really thrilled to be working with Queen's Partnerships and Innovation, Amanda, their team. You know, we do a lot of work together, you know, and this workshop today is, you know, at their request. So, you know, as well at Queen's, we work with the DDQIC folks, or Dun & Bradstreet. We work with a lot of young startups coming out of the university ecosystem. And, you know, together, whether it's partnerships and innovations, I mean, we support these companies in Kingston quite a bit. We have corporate partners that we work with, you know, MMP, RBC, and MBM. You know, three examples are examples of our private sector partners that are working to support our companies. We work with the Community Futures Development Corporations in the region. If you're in Eastern Ontario, anywhere but Kingston, you know, CFDCs, as they're often called, can be great sources of investment capital in terms of loans and grants sometimes that they offer. We work with the Southeastern Ontario Angel Network, again, you know, the Angel Network here in Eastern Ontario, and through other partners, you know, this is again a strong source of equity capital at an early stage. And our government partners, as I said, we're part of the Ontario Business Support Network, and we also receive support from the federal government, often through FedDev. So, fundamentals of your business. If any of you have, you know, had a chance to talk to me one-on-one before, I often will start when I meet a business for the first time, giving you this simple view that I've come to adopt in terms of thinking about your business in three areas, three buckets of activity, and how those buckets of activity interact with each other as you are growing, and the role that capital plays in that, you know, in supporting that growth. So, you know, I'm old enough to remember playgrounds that, you know, they weren't a health hazard, that we had these things called teeter-totters, and my friends and I would hang out in the park and, you know, figure out all kinds of different ways to play with this type of apparatus. But this point of this balance beam here is to say that, look, as your business is growing, the concept I'd like to give you is that on one end of this balance beam or on this teeter-totter is your marketing and sales effort. And then the other is your operations, the product you're manufacturing, the service you're delivering. And as you grow, I want you to think about having to maintain everything that's good about your company in some level of balance such that, it's sitting on this beam. And if you get too far out of balance either way, things are gonna fall off and you're gonna be screwed. Okay, you're gonna be in a very challenging situation. And the capital, I call it the fulcrum for the science folks in the room, right? The fulcrum of this teeter-totter is your capital. And that's what supports this. And if capital is really weak, then you have a knife's edge, which is kind of what you see here. If you can appreciate, it wouldn't take much imbalance for things to tip one way or the other, and you would be in trouble. But if capital is really strong, then you've got that can turn into a cinder block, right? A much wider base. And you can make some decisions, and you can stress load one side of your business or the other, and not have things fall off. And so just giving you that kind of visual, you might go through, business model canvases and different ways of looking, and these are all fantastic. But this is just for me, when I think about raising investment, I want you to think about you're on this journey of growing your company. And as your company grows, think of this thing as getting higher and higher off the ground, right? The imbalance, the fall is harder. So a company that messes this up at 5 million in sales can be, can really feel the pain even more so than somebody who's just starting out. And the other thing that I would tell you is going after your first million in sales with a cinder block of capital, if you don't continue to look at your capital needs and you're growing to 5 or 10 million, it will turn back into a knife's edge. So this is a fluid dynamic that is always at play in your business. And I use examples like a company goes out and buys, invests in a huge piece of equipment that takes their production capacity, 10 times higher than it is now, but they don't have customers. You've got imbalance. Or a company that doesn't make that investment, and suddenly in the marketing side, you've got, huge demand for your product, but you can't service it. You've got imbalance. Okay. And so when it comes to capital, this is kind of the thing that I want you to think about. Now, just a little bit of a fact. When I first did this type of workshop, I came across this fact, my friends at the internet. So Union Square Ventures, right, venture capital firm in California, Silicon Valley, came up with a stat a number of years ago that said that the amount of money that companies raise in their seed and Series A rounds, so these are companies going after equity investment, is inversely correlated with success. So the more money they raise, the less successful they tend to be. Or the less money they raise at these stages, the more successful they tend to be. So I started thinking about, well, why is that, right? And, here's some examples. Microsoft, so in my generation, in my lifetime, Microsoft, I can remember when Microsoft was a startup. For some of you, that's not the case. These are some examples of Microsoft only raised $1 million. I mean, I know startups that have gone out, I know a startup in the Kingston ecosystem that's about to close a $2 million raise. So, twice as much of, or roughly twice as much, not counting currency, as Microsoft. So these are examples of companies in those early stage rounds that raised, compared to where they are today, a small amount of capital. So why is that? Well, the question I ask all of you is, who should your number one investor be? Okay. And, when the first time I asked this question in a group setting, the answer I got off the bat was, well, us, our founders, we should be the number one investor. But what I'd like to share with you, in my humble opinion, is we're all in a race to make the customer our number one investor. So when it comes to raising capital, let's all keep in mind that we're using capital, debt, equity, grants, whatever that might be, to get to a point where the customer will be our #1 investor. They will be buying our product or service. We'll be doing that efficiently. We'll be generating a profit. We'll be generating cash, and we'll be reinvesting a portion or all of that cash into our business to grow. So I think this is a really important point when you think about raising capital, okay? So when it comes to investment, what are some of the types that we see? What's very interesting is, you look at, this on this wheel from, starting at 34.9%, it's the bank, it's other types of loans, it's personal savings, it's friends and family investing, going to people that know you, that believe in you and are willing to give you some capital to start up. It's people leveraging their credit cards. We go through 4 categories before we get to things like angel investors and venture capital and government funding. And other things. So investment financing for startups comes from a lot of different sources. So equity investment, when we talk about that equity investment pathway, friends and family, angels, seed rounds, again, companies can go through multiple stages of investment. And we're going to talk about this. We'll talk about this a little bit. This is where maintaining the value, what's the value of your company at each stage? How much equity are you keeping as founders? This becomes very, very important. It's something that at Launch Lab, we spend a lot of time understanding. If you are going to raise investment, how much at what time based on valuation. Our goal is always to see you keep as much equity as possible. Do you leverage strategic partnerships? Again, a key. Do you leverage with things like grants from organizations like IRAP, OCE is now OCI, training grants, job hiring grants? Do you leverage equity with debt? So leverage becomes a key component when you think about the investment strategy that you're going to put forth in your company. Okay, and oftentimes we see examples. I know many examples of companies that might go out to an angel network and raise $300,000, but leverage that 3 or 4 times to, and so that they're really only giving up equity on the 300,000, but they're getting some grants. They're getting some, maybe they're taking on debt at the right time. Maybe they have a strategic partnership. And so they can really lever the equity that they're raising when it comes to the total capital they need. So again, on the investment side, valuation becomes important. Multiples of this term called Ebitda, it stands for earnings before income, taxes, depreciation, and amortization. It's a measure of cash flow in a way. It's a way to measure businesses in different industries or sectors based on companies that are profitability or generating revenue. Sometimes you'll see companies valued as a multiple of the revenue they have. If you're a startup and you don't have either of those things, then valuation becomes, it's an art, not a science. It's a little bit of witchcraft. It's a little bit of, promotion, right? What are the things that you can do to talk about what you think your value is when you don't have cash that's being generated by customers? And this concept of traction becomes important. Is there somebody out there other than you that really believes in your idea, and that someone or that organization or that company has a lot of value unto itself? So strategic partners can become a very key thing. And remember that when somebody's trying to value you, they're looking for a return. They're always leveraging it against risk. So they're doing a risk analysis and they're trying to decide, if I put money into your company today, how do I get a return? And what's the risk of, the growth? How well do I believe in the growth that you're going to achieve? Okay. In terms of the pathway that can happen, debt versus, debt, this concept of convertible debt. There are instruments out there where an investor will say, you know what, I don't really know what your value is. And rather than having an argument, how about I invest in your company? I'll let it sit there as some debt. We'll earn some interest on that debt. You won't pay me the interest, but it'll just accrue. The debt will get a bit larger. And then down the road, when you raise some more money and you've got more traction and valuation is determined, I'll convert that debt, or I'll have an option to convert that debt into equity. And so, you know, my friend John Malloy, who for many years ran some of you will know, who ran was the head of Partech for a long time, and then has been more recently the managing director of the Southeastern Ontario Angel Network, was fond of saying to me, Scott, the nature of any deal when it comes to investment is only limited by the creativity of the parties. So these deals can be very tailored to the individual situation. Okay. And again, investors want to know, how are they getting their money back? You know, how are you going to, this is a key thing if you're going to go and raise money. You walk into a bank because you want a loan, the bank wants to know, how are you going to be able to pay the interest that I'm going to charge you? That's their return. You walk into an equity investor, whether that's an angel firm or a venture capital firm, they want to know, how are they getting their money back? Is there going to be a liquidity event where your company is sold or you go public, right? You know, look at the Shopify examples of the world. You know, what is going to be the path that early stage investors will get their money? Are you going to pay me dividends if I become a shareholder in your company? If I give you debt, are you going to pay me interest? Or is there going to be some combination? But when seeking capital, you have to put yourself in a sales mode that says, I have to go out and help the people that I'm talking to understand how they're going to get their return. It's no different than if you apply for a grant. You get a grant, you're applying for a grant. The people giving you that grant want to know, well, are you going to create jobs? Are you going to generate sales? What impact? Because they have a mandate for that grant. So you're always trying to understand or help them understand how they will get a return if they are going to invest in you. Traction, you know, again, you don't have sales yet. What does traction look like? You know, your team is really, really, really important in this. The market that you're in, you know, are you in a big market that's growing? Is this, you've heard the term, the rising tide floats all boats, right? You know, if you're in a competitive market and it's small and not growing, there's a lot more risk than if there's a few competitors in a massive market, or a lot of competitors in a massive market. If this is a rising market, then investors will feel that you'll have a better chance of at least capturing a portion of that and being able to get to a return. So what does that mean in the end of the day? You have to have a plan. You have to sell your investors on your plan, and your team becomes very, very important for that. So when I think about, is your business ready for investment? What does success look like? You know, you've got to think about, when you're talking to these investors, how are we going to provide our return? You know, does it come in profit, cash flow, and over what time frame? Okay, I'll just go back to this for a second. The time frame is really important. What I often say to people, if you're going to raise equity capital, you're going to go to angels or VCs, they typically are looking for 10 times their money back within 5 to 7 years. So to give it a real simple example, if I give you $10,000 and you tell me you're going to give me some shares on the basis that your company today is worth $1 million, okay? So I'm getting 1% of your company today for that $10,000 investment. I'm looking for you to write me a check for $100,000 within 5 to 7 years. That would mean that your company would have to be worth $10 million 5 to 7 years from now. You got to prove to me on your growth expectations in the market. I got to believe that you and your team can get your company in 5 to 7 years to 10 million. But it gets a little bit tougher than that, because a lot of times early stage investors, there's this thing called dilution. They think that you're going to go out and have to raise more money to do what you need to do. And if that's the case, my position as an investor is going to be diluted. So they'll often say, I think, to be safe, if I want 10 times my money back, I think you need to grow by 30 times in 5 to 7 years. So your $1 million company needs to be valued at $30 million 7 years from now. And if it is, then as an angel investor, I'll start to feel a little bit more comfortable if I believe in that path, that yeah, new investors will come in, I'll get diluted by a third, but I'll get that $100,000 check for my $10,000 investment. Here are the stats on that process. For every 10 investments that an angel investor tends to make, 1 of 10 does what I just said. Now, 9 don't fail. Some take longer, some return less, but often angel investors, out of every 10 investments they make, they're looking for that one home run that will feed the other 9. And so, you know, again, this is, when you think about selling, this is what equity investors are looking like. So if you don't think you're going to have that type of growth, well, then it just means that equity, you know, at this stage, angel investors, venture capital isn't the path for you, but there's lots of other types of capital or investment that you can go after. Okay. So on the traction side, you know, customer validation, prototypes, early stage partnership agreements, right? All of these things can be things that is the market validating what you're bringing to market. These are going to be really important things. So what milestones do you have? Are you hiring people? You know, Tim convinces Jonathan to join his team. You know, Jonathan has a world-renowned reputation in his field. Tim must really have a really great product to get somebody like Jonathan to join. So hiring your team can be a form of traction. Creating advisors, you know, who again have choices. You get Angela as part of your advisory team. I know for a fact that doesn't happen very easily, right? So if you've got Angela willing to support you on your advisory team, then you must know what you're doing. Check marks on the traction scale. Okay. You know, conversations with customers. I often call it the, you know, looking for, non-binding letters of commitment or letters of interest. I've taken a look at Tim's product. I'm really excited when his MVP comes to market. I'm looking to, you know, I really think this could help our, you know, our customer base. That's the type of validation that sometimes you can do. Intellectual property. You've got something that's patentable. You've got a trademark. You've got, you know, copyright protection. Maybe you're thinking about a trade secret. You know, things that you feel are unique in that area and you can protect can form, can form traction. It can be part of traction as well. You're putting your own money and time into this. You know, maybe you've got that world-renowned reputation and you're choosing to do this. So you want to think about how you sell to any level of investor, debt, grant, equity. What kind of traction do you have? Really, really important. And I'm going to, you know, go through this a little bit quickly now, but, you know, the A team with the B product is a heck of a lot better than the B team with the A product. Early stage investors invest in your team. And what we see at Launch Lab, and what I've seen in my experience, is a lot of early stage companies are typically lacking expertise in 2 areas, sales and finance. They often come to the market with the product. Financial expertise is actually easier to solve. There's lots of good virtual CFOs or financials, so there's ways to solve that. But driving sales is probably the biggest thing that investors see as a challenge in the companies that they invest. Everyone will tell them they're going to drive sales, but actually achieving it is another thing. And I know my friend Jonathan knows all about that kind of stuff. So I'm going to stop for a second, take a break. But, you know, again, thinking about this, you know, here's some comments from somebody that said, you know, I kind of smile when people come to me with the early stage idea and say, I want to tell you about my great idea. Will you sign an NDA? He says, I'm willing to sign those NDAs, but to me, ideas are not nearly as important as the execution. I really want to understand how well you're going to be executing. And he taught, now I found that his math was wrong in here because, you know, 20 times 10 million is not $20 million. So I just, you know, if you know, the other thing with raising investment, you want to get the math right. But the point of this slide is that, you know, if you're good on the executing side, you're that A team, then you're going to have some, you're going to have a really good chance at taking even a so-so idea or a good idea and creating a strong market position. It's not always the best brand that wins. It's not always the first. I'm going to stop for a second, but think of BlackBerry. You know, Research in Motion is credited with inventing the smartphone. They lost that mark, you know, Apple and, you know, so it's often, and there's often not room for number three. I listened to somebody the other day when it came to BlackBerry said that as soon as Android came out, right, you had the iPhone, you had Android. As soon as he saw the Android platform in Google, he sold all of his BlackBerry stock. He said, there will not be room for a third player. The third player will die. So even though there's a Canadian story, arguably a successful company, but they didn't win the race in terms, even though they were the ones to arguably invent the smartphone. So I'll take a break there for a second, and just, you know, happy to answer any questions. Or are there any thoughts? Does any of that make sense? I've got a few more things that I'll talk about in terms of raising investment, but I think the key things for me today were to give you a sense of how important I think your business model is, that you recognize that there are lots of different sources of capital out there, and that it comes to putting a strategy together that says the capital we're going to raise is going to help us get to a point where the customer is going to be our number one investor. There's not too many companies that fail for having too many customers. You know, I'll give you a personal example of a company I was involved with where I was the CFO and I was raising money. I was with them for about 11 years, and this goes back to the 90s, but we invested, it was a family investment, but we invested in the company when they had about 1.5 million in sales, and over 3 years expanded into the US and grew the company to between 8 and 10 million a year in revenue. But when we got to that level, we found ourselves, we looked at our financials and found that we were break even. We were actually making more money at 1.5 million when we started the investment than what we were making at 8 to 10. But we had a lot of customers, which meant I had the opportunity to look at our business model, look at where we were inefficient, change it. We actually reduced sales down to 6 million. And by investing in our manufacturing process, we generated $1.5 million of cash every year on 6 million in sales. I had customers, right? So I was able to, you know, as opposed to having no customers at all. So, you know, if you've got customers, you got a chance. Any thoughts or questions? I'm just looking, we've still got some time and I can keep going on some of the presentation. Jonathan, you've got your hand up, fire away.
Yeah, I have a question about planning, you know, because we try to plan as much as possible, but as a startup, I mean, it never ends up how it starts. We're going through iterations and we're releasing sort of a minimum viable product. And then you see, oh yeah, in this book, 0 to 1, the guy says, oh, Steve Jobs, the greatest thing he designed was not the iPhone, it was his business, and then the ability to execute these detailed multi-year plans. And but once we start planning, you know, a year in advance, or we even did this exercise where we said, with what we're doing and revenue coming in, let's see what it would take to reach 50 million in gross revenue in under 10 years. And after 12 months, I feel like I'm throwing darts in the dark. And so my question is, what are investors that invest in sort of startups and innovative things, what are they looking for in terms of a plan, knowing that it's going to change so quickly and so much?
Yeah, great question. I think a couple of comments in terms of what are investors looking for. So I'll turn it around for all of you. Put yourself in the mindset that you've got millions of dollars sitting in an account somewhere. You know, either you sold your business, so you've had some success. You think you know, you've been lucky maybe, but you also have some expertise. You've run a business, and you want to invest. You know, you've put a chunk of money away. You don't have to worry about the groceries, or you're going to be able, but you actually want to have this pool of money that you're going to make some investing bets. You want to, as an early stage investor, be providing advice to that company. You want to be thought of, or, you know, angel investors want to be advisors as well. They don't want to come in and run the company, but they want to be used for more than just their money. You know, if you were in that position, you know, what would you want? You know, I think a lot of times if you just flip it around, you'd say, well, what would be important to me? Because let me tell you what would be important to me. I know that whatever plan you guys come up with as an investor is wrong. I tell people, okay, as a CFO, as a CEO, I have seen so many plans in my career, so many budgets, right? So many forecasts. And a lot of times I'll talk to startups and they'll say, well, I got to build a forecast, or I got to, you know, I'm really concerned about it being right. I always say, don't worry about it. There's never been one that's right. In the history of humankind, nobody has ever made a plan that has been right. The point is, you're making the plan, okay? And how close to right are you going to be? It's a guidepost. It's something that you and your team can use, you know, to be able to guide you. Are we moving in the right direction? The worst thing to me is to say, I have this idea of what we're going to do, and I'll come back a year from now and figure out whether it's working. Well, if 3 months from now we've got enough information to know it's not, the opportunity that's lost by continuing to do the same thing and expecting a different result, we've all heard of that definition of insanity. That's what your plan's there for. If you're not executing, if you're not achieving the results you're thinking you should, stop, figure it out, and change something, do it differently. And, you know, pivoting, we hear about this. Investors really want to believe that you're not, I use the example, folks, of try getting in your car. You know, we're in a pandemic, so we probably don't drive as much. I know I've saved a lot on gas in the last year, but try getting in your car and do nothing, go to the store, but only look in the rear view mirror. So just look at your rear view mirror and try to drive to the corner store. I don't know how freaked out you'll get. I know I don't know how far I'd get before, you know, I'll never drive again. It's pretty hard. Well, if all you're doing in running your business is looking at what you've achieved in the past and you're not looking forward and you're not thinking about that plan, then, you know, I think you're going to be in a world of hurt. So I think investors are looking for the fact that you have a plan, you're evaluating yourself. You know, you're always looking at data. You're saying, are we on the right track? Do I do more of it? Do I adjust? Again, you're looking to drive customer growth. You're looking, you know, your customers are, you know, the market will be the ultimate determinant of success for you. So, you know, and there is, and I can tell you many companies, when they look back at their success, will look at ultimate pivots that sometimes are small, sometimes they're large. You know, we have a great product, the market isn't ready for it yet. Let's put it on the shelf. You know, how can we, maybe the market will be ready 2 years from now. Where else can we make money until that time? So Jonathan, I think that's, you know, I think that's really, really key. Terry Matthews, everyone know who Terry Matthews is for those of us, right? Terry Matthews was fond of saying, you know, do a quarterly report to your investors, right? If you don't have investors yet, prepare a quarterly report and sit down with your advisors. And as he says, as a startup, the first line of his quarterly reports always said, sales last quarter were X, right? The sales forecasted for the next 3 quarters are A, B, and C. He says, if every quarterly report, you start off the report by saying sales last quarter were 0, at some point you should say, something can't be right here, you know? And so, you know, create a plan, report on what's happened, but look forward, use new data to adjust your path going forward. That's that execution play. That's what investors really are going to look for.
Scott, it looks like Nurup has his hand up, and then Holly.
Okay, and Holly? Sure.
Marie has hers. Yeah.
Okay, all right. Holly, why don't you go first, and then Nurup, you're on deck.
Okay. Hello, Scott and everyone. So with the increased amount of pitch competitions and people wanting to hear from startups and that, do you recommend these people work with a speaking coach or go for training before they do these pitches? Because I've sat through some pretty awkward speakers?
Yep. Yep. You know, what I can tell you is, and you know, let me tell you, you know, doing this workshop today. So as speaking as somebody who has, before COVID, you know, the thought of doing a workshop like this would mean I would be in a room with all of you. You know, when I see that slide deck, like as I was going through those slides and I couldn't see any of you, totally uncomfortable. I want to feel the reaction of the room. I want to have a personal interaction with each of you. Difficult to do, you know, easier seeing all of you on my screen. Holly, you know, PowerPoint presentations are, I love slides that have very few words on them. Figuring out how to present, how to communicate, because again, investors, if we're talking about investors are investing in you. You know, it's the A team, it's the B product. You're looking at, hopefully it's an A team and an A product, but it's team first. So anything you can do to seek feedback on what your presentation styles are, really, really important. And you're always presenting. You sit down with your banker in their office, you're presenting, right? We're always selling. And so I think how you sell is really, really important. Really quickly, CFOs, if we've got any aspiring CFOs, I often say, what's the difference between a chief financial officer and a controller or an accountant in your company? The chief financial officer sells, okay? The VP of sales sells to customers. The CFO sells to sources of capital. They go out and they talk to people. They talk to sources of capital before you need the money. I often say that a banker only gives you an umbrella when it's sunny outside, never when it's raining. So you better have the relationship with them so that when you need them, they're there for you. So to answer your question, Holly, it's a big yes. I think that how you present is really, really important.
I just have a follow-up. Would you guys, through Launch Lab, would you host a speaker to help people with speaking online?
Yeah, so it's something that we always look for those opportunities, Holly. A lot of times we have work with our partners as well, like our folks at Queen's, for example. You know, there's an innovation program at Queen's University. In the summertime, I know that they have often speaking components, you know, or people that come in to talk about speaking. So I think often it's in relation to, and I think you and I had talked about this in the past a little bit when we met down in beautiful Cornwall. You know, is you know, making it as part of a program is often what we look for. We often encourage companies at Launch Lab to seek out people like yourself to be able to identify, you know, to look at themselves and say, well, what kind of information, you know, what kind of growth can you have in that area? To me, the relationship you're talking about is very much a one-on-one coaching, you know, as opposed to a group setting like this. So
yeah, well, you'll be happy to know I finally went online. I dropped my stuff in the chat, and I'll be following up with Launch Lab because that's now what I do.
there you go. You see, your job now is to close us, Holly. So there you
go. I
can,
know. So
yeah, always be closing, right, Jonathan?
I'm sneaky, and
I know. All right. So Narup, you had a question?
I do indeed. Good afternoon, everyone. Thank you, Amanda, and thank you, Garrett, for responding to my email, and indeed for everyone for hosting this. My name is Narup. I am leading a company called 321 Go Check, which is a digital background checking company on tenants on behalf of landlords and on employees on behalf of employers. Just a quick background. My question then is, I know you talk about the A team and B product and you talk about valuation, but how much are you actually making a decision based on the individual? That seems to be intangible, but in the back of your mind, is there something that you're measuring instinctively? Yeah, this guy's got something. Are you in the back of your mind thinking, yeah, put the numbers aside, put the team aside. Is there something in this person that makes you take an extra step forward or makes you respond a bit earlier. Is that resonates in any way, shape, or form with you?
Yep, a great question. I think in my experience and in the experience of, you know, working with other investors and watching other, you know, at Launch Lab,
Yeah.
I'm often helping companies like yourself, you know, develop their investment strategy, helping them get ready to pitch, right? And you know, I think I've seen a lot of early stage investors invest in the team. I've heard investors come back to me and say, you know, I'm not sure about it's an intriguing product. I'm not sure about the market, but I really believe in how smart the founding team is. And I think with my advice, if you know, I'm going to give them a chance to prove the market. But back to Jonathan's point, you know, once you've got that money in the boat, it's like, okay, well, we're going at, you know, the market can change, the direction of the company can change, but it's hard for me to change the team. So I think as an investor, that team and that belief in the founder, Nirup, becomes really, really important. That's been my experience. You know, especially at an early stage. Now, you know, if you've already raised money and you're going after $5 million now, you're in a Series B or C round, you're building out a team. You can go out and hire really great, you know, a really great management team. And the skills of one particular individual can be diluted a little bit. And probably what starts to take over at that stage more is, are you truly capturing market share at that point, right? I'll give you guys an example. One of my EIRs, who some of you might know, his name's Mike Amos. Mike started a company called Empathica. He sold it in 2013 he started it in the 2000s, so a little over 10 years he ran the company. He had a big exit. He didn't go public, but he was bought by a large company, and he invests in real estate and doesn't worry about ever having to work again. And he works with, you know, he works as an advisor at Launch Lab. But he talked about the fact that in his journey, he actually built the company to 4 or 5 million in revenue before he went out and sought venture capital investment. He went out and had the market. He figured out a way to, you know, get the market to create that traction component before he went out and raised significant venture capital. Right. And so, Nirup, I think you get this combination sometimes of, you know, depending on where you're at. So it's never one or the other, but I think team is really, really, really important.
Right. Okay. That's great. Thank you for that, Scott.
Okay.
Hi, Scott.
Hi.
A quick question here.
Yeah, go ahead.
Yeah. My name is Bashid. I'm with Alucia Lingerie. And I'm a recent graduate out of Queen's University. And my question here is, so you mentioned experience and the A team. I have previous work experience in sales and finance, but coming as a student, saying that someone who's been in the industry for years, a potential investor, I don't want to come off as saying, I think this internship's enough to propel me forward into success. I also want to say that I have advisors who are also giving their share of expertise. But at the same time, I don't want to undersell myself. So how do you strike that fine balance?
It's a great question. You know, I think that, again, at an early stage, right, if I were in your shoes, never sell yourself short on the experience. As an investor, never be shy about, you know, never be shy about feeling confident about what you can do, right? And depending on where you're at, I often say this, that, you know, I'm 55 years old, right? So I mean, I remember when I was at Queen's, and I still think of myself in those lives, but the reality is I'm not 20 anymore. So guess what? I don't like to work 20 hours a day, right? I've got a little bit of gray hair. As an advisor for any one of you, there might be times when you could leverage a little bit of gray hair depending on who you're going after. But at other times, sending the gray-haired person into the room is the worst thing you could do, you know. And maybe it's more that youthful experience. It's that sense of. So I always find with selling and with the team, if I was building a team today, I would want that combination of I'd look at who my founding team was, and I would really look closely about, you know, who could I surround myself with on an advisory team. And here's what I would say to all of you. You know, building an advisory team is a great way to create that A team before you really have the money to hire a full-fledged cross-functional management team. To be honest with you, at Launch Lab, why does Launch Lab's advisory model work for our clients? Why do our clients appreciate it? Well, sure, hopefully it's because our advisors are really dedicated to wanting to help you, but it's also because our clients don't have that fully cross-functional management team yet. I have Launch Lab clients that are doing 15 million a year in revenue, but it's a husband and wife running this successful company with 70 employees, but they don't have the CFO, they don't have the VP of sales. And having Launch Lab advisors as part of their advisory team helps them to make the right decisions. You can compensate advisors. You could offer them 1% of your company, you know, 1.5% of their company. And they give you a day a month of their time. They'll pick up the phone and make introductions. They will give you advice. So there's lots of strategies, Bashid, that you can use to kind of complement that youth team that you've got, and you know, the experience that you've built. You know, I go back to Jonathan's comment. I know you're going to make mistakes. I know the plan's not going to be right. It's about really having the belief that whatever happens, we're going to pivot, but we are going to win at all costs here. We are going to capture the market. That's what people will invest in.
Awesome. Thank you so much.
Is that helpful?
Yes, very.
Okay. Any other, just looking at the time, any other questions at this point? One of the things I'd like to do is take a few minutes to give you a sense of some tools. I'll go back to the PowerPoint and share with you guys some tools that we have seen be effective when you're looking to raise investment capital. And, you know, Holly talked about our presentation skills. What should your investment pitch deck look like? How should you approach you know, seeking investment when you start to go through that sales process? So I'd like to reserve a few minutes for that. But before I do that, any other hands up, or should I move on? I guess I got about 5 minutes, so maybe I'm going to come back then to the, and what I'm going to say is I'm happy to provide this deck to Amanda and Garrett, share it out, and I'm also happy to you know, share this or have, as I said, any follow-up discussions. So if there is anything that that you want to follow up with me on, I'm happy to do that. So so seeking investment, you know, you got to convince, this came from Paul Graham, founder of, I know many of you might know Y Combinator, but convince yourself that your startup is worth investing in. You know, when if you'll invest in it, then it's easier for you to explain why others will, you know. Here's another great thought for you. Investors are pinched between two types of fear, okay? The fear of investing in you and you fizzle out and I lose my money, but there's also the fear of missing out. You know, Holly came to me and pitched her idea. I didn't think it was a good one. I wake up a year from now and, you know, she's the next Shopify, right? Like, they are worried about that. So, you know, this is what you're trying to capture them. And so what I wanted to show you first is the first tool that we developed this with angel investors, is something we call an investor profile document. This is a one-pager. Think about it like your resume. You know, this format was built in conjunction with working with angel investors a number of years ago with an organization I was with. And it's just a way to say, you know what, the way I describe this is I walk into the angel network and I say, you know, I met with Jonathan and Tim today. They've got a really cool company. They're thinking about raising investment. Do you think there'd be an opportunity for them to have a meeting with you to see how they might be able to pitch your angel network? And the question I always get is, okay, Scott, I trust you. You tell me they're good. Send me their one-pager. Send me something that I can just get a sense of who they are, what they're doing, and then we'll schedule the meeting. So having this one-page document, and this is a template in Word that I can share with you, build this out. You know, who you are, if you have a tagline, your logo, give me a paragraph of what you're all about, Give me on the right panel some information as in terms of just static, how do I get in contact with you? Do you have a little bit of traction on the funding side? What are you going to do with the money? How many employees do you have? Walk me through, and keeping it to one page, tell me the problem you're solving. Tell me the solution you have to that problem. How big is the market? What's your competitive advantage? How are you going to go out and actually make money? What's your business model? Do you have any financing in place right now? Any milestones that you've achieved? So you can see how just top to bottom, tell me the problem you're solving, right? So that one pager becomes very, very important. And then finally, when it comes to your pitch deck, what I wanted to show you here is, so again, this is some comments from an angel investor where he said, I've seen many presentations, right? A little bit to Holly's point, I've never seen one that's too short. So what he's talking about is people tend to ramble on, okay? Maybe it's short on content. In other words, you didn't give me the right information that I'm looking for, but it was not short on pages. So what this person said was, look, a perfect number of slides is 10, the right content, you can deliver it in 10 minutes. Get a conversation going, right? What does those 10 slides look like? So problem and market need, solution, opportunity, business model, competition, what's your marketing sales plan, any partners you have, who's your team, give me some financial projections. We're not talking about a spreadsheet, with small numbers on a slide, high level, speak to the growth of the plan you have. What money are you raising? What are you going to do with the money? And most importantly, tell me how I'm going to get my return. What's your exit strategy? Okay. And again, in each of those, and this will be in here, for each of those things, some comments from that person around what you should be trying to cover in that slide. Somebody like Holly, who I first met, who focused in on presentations, for giving presentations like this, is this person said, you should never have less than a 30-point font on any slide you ever produce. I can tell you that when I produce PowerPoint presentations, personally, I try to live by that example. I like to put pictures, I like big words, because I want the focus to be on me, good or bad, when I'm making that presentation. So, one-page venture profile, a 10-slide investor deck are the tool sets that can get you in front of an investor, remembering that when you give that investor pitch, your only goal is to get somebody in that room to say, Scott, I was really intrigued by what you said. I'd love to have a follow-up meeting. I'd love to do a little bit more due diligence. Nobody's writing you a check when you give an investor pitch. So that's not your goal, right? I can see. So this is a strategy that you need to learn to develop. And also remember that pitching for investment takes time, right? If I'm looking at Tim and Jonathan, I don't want Jonathan pitching to investors because I want Jonathan talking to customers. So Tim, whether you like it or not, you're doing the investment pitching, right? Because we've got to this is, again, the team approach to things. Investing takes time. You want to raise angel capital? You have a good pitch tonight at an event and somebody says, I want to have that follow-up meeting. You could still be 6 months away before the money's in your bank account. By the time the agreements are struck, the lawyers have looked at it, all of these things. This is not a process that gets you money tomorrow. So you've got to be thinking about, do I have enough cash for the next 6 months? I'm actually raising for money for time in the future. So I go back to that teeter-totter that I showed at the very beginning, right? Capital is that fulcrum that is helping you. You've got to be forward thinking. And I think companies that are looking forward are thinking about what they need in the form of capital 6, 12, 18, 24 months. Somebody on the team that's talking to those sources of capital, building relationships for when they need them, are companies that tend to, in my mind, have a better chance of being successful. and never take your eye off the prize, and that's the customer. The customer needs to be our number one investor. So I will, happy to, as I said, I think we're probably around the time, Amanda, but I'm happy to stay on, so I don't have to leave right this second. I'm happy to continue any conversations or thoughts. I hope this has been helpful. Tim, you got your hand up. Fire away, my friend.
Yeah, I just want to, for the people in the group, apologies, I don't know everybody here, and I won't ramble on, but to really hit home on the message that Scott talked about was, as an example, me. I came into Launch Lab with an idea in a company. I brought it as far as I thought that I could take it after several pivots and iterations. And then I met Jonathan, who I was looking to buy something from him. I didn't want him to be part of my company. And after a 10-minute conversation with Jonathan, I quickly in my head started to think, how can I get this guy on board with me? What is it going to take to have this guy as part of my team? Because I knew that even though I felt very comfortable being in front of people, talking, pitching, I have a good business sense, I've never sold anything. I'm not a salesman. And Jonathan had come from 2 other startups that were, sorry, Jonathan, failures. And he has absolutely no knowledge of the space that I'm trying to tackle right now. But I looked at the person and what he could bring in terms of the customers and getting those customer contacts out there. And he was so valuable to me as a team member that I basically gave up half my company to bring him on board. It was that valuable to me that even though he knew nothing about special needs people or vulnerable sector or older adult care, that was all me, but he was that missing piece. So for me to create what I felt was a strong enough team that we could take basically a non-health, but a healthcare company and try to launch it in a pandemic, which is idiotic. But we've been able to do that together as a team. And we're actually at a point where we are now creating month over month revenue and growing our business. And I wouldn't have been able to do that alone. And so don't be afraid to take somebody on who maybe doesn't check all the boxes in terms of what you're trying to create as your business, because it takes a whole bunch of different pieces to create that really great team that Scott's talking about. So just as an example, look around at your resources, try to find those people. They're out there, they exist, and they really do add value.
Yeah, thanks, Jonathan. I think, echoing that a little bit, I think that there are, and I think, and happy to have this conversation with any of you from a Launch Lab perspective. I mean, Bashid, you talked about, being a youthful, you've got a youth team, you're passionate about what you're doing, the industry, what you want to create, you've got a strong vision for the impact you're going to have. That is, now how do we fit some pieces in to just create that from an advisory perspective, to give you that best chance to really succeed, help you understand what is the right amount of capital, what are the right pieces from a team perspective, who can help open doors in the markets, when you decide who your customer is. That's really what the role that Launch Lab tries to play with companies right across Eastern Ontario. And, the good news is for all of you is that's a model that at the front end is supported through our funders such that, the cost of that to you is discounted down to, I'll never say anything's free because nothing is free, but discounts can be down to zero for a period of time. We're invested in wanting to see you reach your success. And that team development is really, really important. I'll go back very quickly to my friend, Terry Matthews, who said, do your quarterly report. Sales last quarter were X, but Terry also came to Queens, and some of you, I don't know if Amanda, if you remember this, or Angela, if you were there, but he came and talked to a group of Queens young startups that were working, we were at Innovation Park at that point. And he said, when I started my company, and I believe he was talking about Mitel, which was the first company, the major company he sold, he said, my partner and I started it with a loan for $3,500. And he said, after a year, we were 1.5 million in sales. And by the end of year 3, if I remember, we were over 60 million in sales, and we went public. So we did an IPO. And of course, back to everyone's like, oh, wow, that's amazing. Well, as he went back to, he said, well, now let's go back to the beginning. I had a loan for $3,500. I didn't get to $1.5 million in sales by myself. I had to build a team, and I had no money for that team. But what did I have? I had equity. I created a stock option pool. I went and hired people like Bashit, some young, he was speaking at Queens. So he said, I went and hired some great Queens graduates, right? You know, and I offered them equity because I couldn't afford to pay them right away. So, you know, there are lots of tools you have to build a solid team. Part of it is just, and I think as a CEO, I always think of myself as, when I'm in a role as a CEO, I think of myself as not being the person who has all the answers, but being the person who, quite frankly, is comfortable saying, I don't have all the answers. I don't know everything. I need to surround myself with people that can bring the right complement. I need Angela to give me advice on my IP strategy, because if I try to do it, as a colleague of hers said, you know, we can do our own tattoos. It's not advisable. We shouldn't do our own IP. We shouldn't write our own patents, right? So, you know, you want to, as a CEO, as a founder, understand where your strengths are and go and find a way to hire the complementary pieces. I think that's probably the biggest thing you can do. Okay, lots of stuff in the chat. Anything, any other comments or questions? Or my friend Garrett Elliott from Launch Lab is here. If any of you would like to have a conversation with me or anyone on our Launch Lab team, www.launchlab.ca. On the front of the homepage is a button that says become a client if you're not in there already. If you are in there, feel free to reach out. As I said, Amanda has my contact information. I can't thank you enough, Amanda, for giving me the opportunity. I look forward to being able to do this in person. And before I do that, Holly, I'll reach out and you can give me some coaching on my presentation skills, because I could always use a refresher. So.
Awesome. Thank you so much, Scott.
Yeah, go ahead.
Oh, just thank you so much for coming on here and doing this presentation. And I hope that everybody found it very helpful. Yeah, so if you don't have Scott's email address, you certainly have mine. I sent out the Zoom link. So if you reach out to me, I'm happy to do an e-intro or give you Scott's contact information as well.
And Amanda, I'll fire you off when I sign off. I'll PDF the PowerPoint deck, and you know, if you want to share that with the group, or if anyone wants it, you can just reach out to Amanda and she'll have it for you.